Welcome everybody to our second webinar focusing on the offering memorandum exemption. Today we're going to really drill into how to actually market and how to market direct to investor and how we're going to do or how to do that in Canada. We're going to leverage off of a fantastic panel of speakers, including Rebecca Kacaba, the CEO of DealMaker, Dave Rokoss, who has a very unique experience, having run a couple of Reg A's in as a Canadian issuer, but also run direct to investor deals in the US, and Andy Andrei. I will get through, just before I do a more formal introduction to everybody, a quick disclaimer that this is the general information about business practices and certain exemptions available under securities law in Canada. You should not act upon the advice that we provide without seeking professional advice from a lawyer licensed to practice in your respective province, state, or country, or a business advisor directly retained by you. And these are our opinions only. So first off, for today's speakers, as I mentioned, we've got a fantastic panel. Andy Andrei, who's an associate lawyer at Ozio Law. So Andy solves legal and business problems for high growth companies, from founders with an idea to later stage businesses. She works with clients on all aspects of business operations and strategy, whether it is to raise capital through debt or equity financing, both on the public and private markets, buy or sell all or part of a business, ensure corporate governance and public company regulatory compliance, or discuss a customary commercial agreement. Her work also involves representing companies on their go public transactions through an initial public offering and a reverse takeover and capital pool company listings. And probably most importantly, I would say that she is probably now at this point one of Canada's foremost experts on the offering memorandum exemption. And so a fantastic addition to the panel. Next up, we have Dave Rokoss, who is head of corporate development at Shackelford Pharma. Dave has a 20-year career as an entrepreneur and consultant, working with a variety of private and publicly listed companies, focusing on concept development, finance, and operational management. David successfully founded and developed 3 private retail concepts, which grew to more than 24 locations across Western Canada and the United States. And for the last decade, he has consulted with numerous early stage companies across retail, clean tech, energy, and technology sectors, focusing on business and corporate development opportunities. And as I mentioned, a very unique perspective as a Canadian working with Canadian issuers doing direct to investor raises in the US. So welcome, Dave. And last but not least, we have Rebecca Kacaba, who is the CEO and co-founder of DealMaker. Prior to joining DealMaker, Rebecca was a partner at 2 of the major Canadian and international law firms and practiced on Bay Street for over 10 years. She founded the startup practice group at one law firm and was the co-chair of the Toronto Venture Technology and Emerging Growth Companies group at another. Rebecca's vision and drive have landed her in Lexpert's top 40 under 40 and recognized as one of America's most innovative lawyers by the Financial Times. And most importantly, as co-founder and CEO of DealMaker, she's led the development of DealMaker, and has over 800 private placements, including everything from friends and family and accredited investor all the way up to a significant number of direct to investor offerings under her belt with DealMaker. So welcome to everybody.
Thanks, Mike.
Welcome. Now I'm going to pass it off to Rebecca just to give us a little bit of context of what we're talking about today in terms of direct to investor marketed raises, as well as a little bit of background on the offering memorandum exemption for anybody who missed out on our last webinar.
Perfect. Thanks, Mike. So I don't want to take up too much time because I know we're all eager to hear Dave speak today, but I wanted to give you guys a little bit of context about, we're going to use a lot of buzzwords over the next hour. And so I know there's a lot of issuers in the audience. We want to give you some context as to what we're talking about when we're saying direct to investor retail capital raising. Okay, so you've got your company, you're ready to get it funded. There's a bunch of different opportunities that you have in front of you that you can do that. You can go the VC route, right, where you're giving up a board seat, you're getting a large check at a certain valuation, you're issuing pref shares. You might decide that you're going to go public and you're going to continue to raise on the public markets, in which case you're doing a friends and family private placement or a smaller seed round. So there's kind of that private placement bucket with a path to going public. And maybe that path to going public is going to involve some angel or seed rounds, or maybe it involves forming a CPC and doing a reverse takeover with a CPC, and you might get some capital out of that. And so retail raising is something that fits in with some of these things. You can do it if you're going to go on the going public path. We see a lot of US issuers going the venture capital route, doing a retail round as well. And we'll talk about some of the benefits of it later today. But think of this as a new avenue where you can be going out to your mailing list, going out to your everyday investors, and going out in very large quantities as a new pathway to raising capital. And so how does that new pathway happen? It happens under certain securities law exemptions. So in the US, it's often referred to as crowdfunding or Reg CF, because that's a very common exemption, allows you now to raise up to 5 mil. So a lot of people using that exemption for retail capital raising. Or you might do it as a Reg A, where the limits are even higher, up to 75 million. But the strategies that you're using of going out to these large lists of people and getting a large number of investors are the same. And that's why we're calling it retail capital raising. In Canada, the exemptions you might use are startup crowdfunding, not very well used because the limits are so low, only up to 250 twice a year. But the one that we really want to focus in on, and the one that Andy has so much expertise on, is using the offering memorandum, because there's a lot of similarities between offering memorandum and Reg A that allow you to make the Reg A a North American offering, access investors across North America with very little effort. So just to recap, we talked a lot about this in our last OM seminar, a lot of the technicalities Andy took us through. You can find the videos of that online. But the offering memorandum exemption, the retail capital raising exemption for Canadians, is available for companies at any stage of their life cycle. So maybe it's a very early stage round for you. Maybe you're already public. Doesn't matter, you can use it. You can market and advertise the same way you advertise your product using SEO and those kinds of ways of marketing. You're going to do that to do your retail capital raise online. And what's that going to do is give you access to a very broad pool of investors who can also function as beta customers, your customer base. A lot of really interesting benefits there. Some of the nuanced benefits of the offering memorandum exemption are that you can do many times, many different ways. Andy can talk us through questions on that in terms of the licensing that may be required if you do it again and again, but there isn't a limit on how many times you can do it. If you're a private company, you remain private. You don't have to necessarily get tied up in the public company reporting regime. And you can leave the offerings open for a conceivably long period of time. Same way you can have a Reg A open 1 or 2 years, you can keep an OM open for an equal amount of time. So it's a really nice sidecar to that raise.
And that, thank you very much, Rebecca, for that background. I'm going to stop sharing so that we can see everybody, and we'll jump right into it. And I think I will open it up first to Dave and kick it off with him. So Dave, having run 2 Reg A's for both Shackelford and Zen Labs, what are the benefits of a direct to investor offering, and why did you choose to do a Reg A offering?
Well, I'll start with Shackelford because I'm more intimately involved with Shackelford. But in that particular case, there was a company, we had started a company back in 2018. And there's a lot of different components here. We started it in 2018. The individual behind it, a guy named Dr. Alan Shackelford, is actually quite renowned within the medical cannabis space, and he was based in Colorado. When we initially financed that, that was financed at a seed round amongst the usual suspects. I'm based in Vancouver, and we had a number of individuals and even brokers and the typical group that you would go to for initial seed financing. The expectation was that we would follow a traditional route. There's a lot of things you can't control in the market, as everybody knows, and one is sectoral swings. And at the time, we were actually contemplating doing a significant raise. It coincided with a time when the cannabis market, which we were associated with, for better or for worse, actually was a traditional pullback at the end of 2019. So we had to kind of recalculate how we might access capital. At the same time, myself and Dean and some of the other folks that we associate with were looking at Reg A's as a potential opportunity. And what I would say is there's a lot of, everybody knows this, but there's a lot of things that you have to consider when you're going down a path of a non-brokered financing. Usually you are working with a handful of brokers, and that built-in distribution is there. So if you're going to do this by yourself, as exciting as it is to have the opportunity to tap tens of millions of investors, you still have to get out there and reach those tens of millions of investors because you don't have the broker network to do that for you. So it really demands a different initial strategy, I think. And from the learnings that we had during that period, and I have to thank DealMaker for making a number of introductions at the beginning of people that had gone through this process and what their experiences were. So we were able to reach out and get a pretty good sense of the infrastructure that is necessary to pull one of these things off. So, having the ability to tap a market where your valuation metrics might be a little bit different than they would in a traditional non-brokered financing in Canada was of interest to us. Tapping a significant investor base of both accredited and not accredited investors were very interesting to us. Having that significant distribution, whereas here you might raise a few $1,000,000 and have 50, 100, 150 investors. For the one we just wrapped up, I think we had 2013 at the end of it. And of course, having access to an investor base we never traditionally would have had access to. So these were all drawing factors for our company. But more importantly, we thought we had a story that would resonate beyond a traditional brokered financing. So the big learning we had was that in order to get that distribution, it wasn't something that we can do ultimately by ourselves. We couldn't rely on a broker, we can do by ourselves. So we had to look at opportunities to work with other groups out there that had access to an investor base that we can in turn market to. And I know you guys are going to talk a little bit about it today, but it really was about trying to find those types of investors that would be interested in our company as an investment. And with the, Rebecca talked about it earlier, with the advent of crowdfunding, it really changed the paradigm in how we reach out to investors and what investors would look at. Reg A was the first step of allowing non-accredited investors in the Robinhood generation to reach out and maybe not invest $10 or $15 or $20,000, but $1,500 or $2,500. And that made it very interesting. And that's exactly the same theory behind an offering memorandum, is being able to access those folks. One of the things I will share with you that just as an interest, and this is why the offering memorandum thing is interesting, is at the beginning when we set up our particular Reg A for Shackelford, we didn't actually contemplate the fact that international investors and Canadian investors still needed to, for Canadian investors, we needed to have the accredited investor certificate signed by Canadian investors. For international investors, they had to sign a foreign investor purchaser agreement. But at the beginning, when we started, we didn't know that. So we ended up having to backtrack to reach out to all these folks. Now, had we done one initial step, which we didn't really contemplate at the time, which was perhaps doing the concurrent offering memorandum, it would have made it a lot easier, because at the end of this, after these 2,000 investors, we had about 150 Canadian and international investors that we had to follow up with, to chase down with DocuSigns and whatnot, to get them to sign these agreements before we can actually finalize that and close it. So, what I would say is there is work to be done here. There is a lot of heavy lifting. But if you do it strategically, when you're online marketing and you're reaching out to investors, the thing we found is, of course, you can control, jurisdictions and whatnot, but there's investors everywhere. We had investors from Hong Kong to Tanzania to, Australia to Canada. But just make sure at the beginning you're doing it. And when we did our offering circular, which I, did with a very good friend of Rebecca's, a cross-border lawyer based in Toronto there, your world of opportunity is basically the world when you're doing these types of raises. So if you do a little bit of extra work at the beginning with your offering circular and perhaps a concurrent offering memorandum, you can really proceed in these knowing full well that you're able to take capital from all investors, accredited or not. And I think that was a very, very big learning. If I had to do it again, and I probably will do it again, I would definitely consider going down that path rather than just exclusively, in our case, a Reg A path.
Thank you. That was awesome, and a lot of stuff that we're going to come back into. You mentioned a few different themes, like tapping into the market, the Robinhood generation, and the rise of the retail investor, valuation. All topics that we'll cover in a bit more depth, as we get through this. But I wanted to open up and just do a bit of a follow-on for Rebecca on that one. Is given your perspective, having during your career as a lawyer advised numerous companies on different raise strategies, and now at DealMaker having launched 750, 800 private placements, including offering memorandums and Reg A's. Why do you like these kinds of retail raises for companies?
Yeah, so I think there's a bunch of reasons that Dave mentioned that spoke to him that are key. A couple other ones that I can think of are founder control. As a founder who's done my own raises, that's always been a big deal to me. VCs, you're giving up board seats, you're taking on someone else's voice for your vision. So one thing that I really like about retail raising is you can do different things like non-voting shares. You can, I think, traditionally get better valuations. So as a founder, there's some appealing prospects there. The other thing we hear from a lot of our customers is the customer list building. Either they have a list they're going out to that they can raise capital from, or they're building a list of investors who then they reach back out to that pool and say, hey, would you like to beta this new version of the product? Can we test XYZ on you? They've got these committed, engaged group that really already buy into the brand and support the brand. And that's phenomenal. I've always used our investor base that way as well. So better valuations, product pre-sales, customer list building, founder control are all different elements that speak to me about retail capital raising as a real benefit compared to just straight going public right away or doing a VC round.
Perfect. And then Andy, for you, and then I'll open this up to everybody, and we can touch on it. But do you feel the OM is easier for some kinds of companies?
Yeah, I think the OM is probably easier for companies that are mainly consumer based, and also companies that are easy to describe and easy for people to understand. Because you're using the offering memorandum form where you're basically setting out your business plan. Generally speaking, you want people to be engaged with that. And so if you can find a way to describe your company in a manner that people can really buy into just by looking at that form, then generally speaking, you'll be more successful.
Dave or Rebecca, any additional comments from you on that?
I mean, off the top, I would absolutely agree. The one big thing about, you have to lump Reg A's and I would say offering memorandums into that pot of conceptually a crowdfunding type of operation, where even though it's equity, it has to be something that speaks to the investor, which is our consumer in this case. And when we initially decided to go down the Reg A path, it was only because there was some testing and feeling out of whether or not what we were trying to sell would resonate with the investor community. Because you don't have that built-in database that a brokerage or dealer house might have, it is really up to your story to be able to resonate, to attract investors to the table. And the retail products are a perfect example. Rebecca said it, Andy said it. A lot of the companies that we talked to before we launched this were retail-facing companies. And even when we started, we had this concept that there may be a piece of our business that is consumer-facing. So even though we ended up with 2,000, I think 13 shareholders in this process, our database that came out of this, which is a whole other conversation, was probably like 3,500 individuals. So if you look at our mailing list now, that people are not only investors, but people that want to follow the, the goings on of the company, it's well over 3,000. So if I'm a retail outfitter, a consumer packaged good company, fantastic, because I now have, 3,500 people that would be consumers of my product. So a lot of the most successful raises, and I'm sure you've heard this before, are consumer facing companies where people are buying a product that they want and investing in that product.
Yeah.
At the same time, I also want to add that I think that there could be a lot of possibilities for exciting companies that captivated the imagination of the public, like in this case, non-fungible tokens or cryptocurrency, cannabis. These are all psychedelics. These are things that people have read about in the news, know about. They don't necessarily have to understand the granular level of the business, but they're excited about investing in these kinds of companies.
Yeah, and technologies, I would say. There's been some absolutely fabulous technology company raises, where, like you just said, talking about NFTs and things like this, people may not understand the background of it, but they understand where this is going, and they get behind these technology shifts. So I 100% agree, and I've seen some fabulously successful raises done that way.
Yeah, as long as you can make it into a proper soundbite that's digestible by the market, and you can make that soundbite exciting, I think there's an opportunity.
Yeah, absolutely. I mean, and, just from the DealMaker's perspective, we've seen so many different types of deals, from very, very technical oil and gas kind of plays, or light natural gas, to consumer goods, to cannabis, to technology, all succeed. So I think that, yeah, the soundbite and being able to break it down is really important. So I mean, Dave, going back to you, we talked about this, building out the marketing plan, the introductions, the different groups. How did you formulate your marketing plan for the Reg A raises? And what, I mean, I guess, and more meaningfully, what avenues did you choose to go to market with to engage investors?
Yeah, it's a great question. And so what's interesting about this, as somebody who comes from the market, traditionally the way, from a corporate development, investor relations piece of a business, of a public company, once you're public, you go out there and you set up an infrastructure to market after the fact to support the stock, and you bring in additional retail support, internationally, as we do here. This kind of flips it on its ear a bit, because you have to actually start that before you raise any money. So instead of trying to attract investors after the fact, you actually need to attract investors before the fact. And it's not an easy question to answer. So, but all those companies now that have been, well, some of them that have been attracting investors after the fact, your traditional marketing groups and agencies and newsletter writers, are now kind of shifting their focus a bit, as we've all seen, to look at the opportunities that are Reg A's and Reg CFs and even offering memorandums, because there is that same opportunity to market to that same demographic with private deals as opposed to public deals. And now, as Rebecca mentioned earlier, as a public company, you can actually still do a Reg A, but that's a more recent thing. So for us, we went out and we just happened to we did two things. When we started this company, I sat down with an individual, a friend of mine, a guy named Miro, who actually has a very sophisticated background as an ex-Globe and Mail, bureau guide, more front page articles than anybody else. And his background was understanding media and understanding messaging and building a narrative. And that goes to what we talked about earlier. It's about really trying to understand what your story is. It goes way beyond branding. It's into the whole communications platform. So how do you really build your story and build your narrative that it succeeds at a number of levels, from traditional media to the investor media and all that kind of stuff. So we crafted our message first, and then we went out to some groups and relationships that we had, including the newsletter community and all that stuff, and tried the messaging. Does this seem appealing to you guys? You guys have an investor base or a network of people that like investing in this sector. would this, resonate with them? And they went out and tested it. And as it turned out, we ended up working, with one group in particular that really focused on the cannabis sector, and for Shackelford in particular, saw that pharmaceuticals and traditional pharmaceuticals, not over-the-counter stuff, traditional pharmaceuticals was the next wave. And they thought, we could build a wonderful story and communication program around this to reach to our investor base. And that's how it started. And really, that was our core focus. So instead of having the brokerage database, we had their database, which really hit hundreds of thousands of people. And it was shocking to me the amount of messages we were getting from people that heard about us on Facebook or this thing or the other thing. And it just goes to show you the power of the targeted communications that they were doing. And and some of my associates, have layered on that beyond their focused marketing and using a lot of different groups and, hyper-focused targeted marketing programs online to extend, that reach to those investor communities. We also use traditional media, groups like Gage Cannabis and all that did a fabulous job working with the Benzingas of the world and all that, getting their message out. So it really is this all-encompassing thing now to reach eyeballs. The Walmarts of the world and everybody else have been doing it for a long time. We're just kind of shifting it. It's on its ear now and doing it with the investor community. And I don't like using these, but the Robinhood generation is much more agile now, right? So, the amount of people that came to us from what I would consider non-traditional sources was shocking to me, but it just goes to show you the power of it.
Awesome. And just to sort of circle back, is there anything that you would have done differently? The way that you sort of went out, maybe with in your experience with the newsletter, anything that you would have done differently from the get-go that you'd like to pass along?
Yeah, it's a good question. So, and it all comes down to budget. There's certain things that cost money and other things that don't cost money. And, I've talked to groups, and I'm sure some of the people here have as well, is that you can easily spend hundreds of thousands or, millions of dollars on that. We didn't go out looking to raise a lot of money. We wanted to raise $7.5 million. We did our offering circular to raise 10 million, up to 10 million. And, once we got over 7.5, we looked at winding it up. We ended up at like 8.85 or some such thing. So we didn't need to raise a lot of money, but if you're a group that wants to, and we closed it. So as Rebecca said earlier, these things can stay open for quite some period of time. So if you're one of the companies, and there's many out there that want to raise 20, 30, 40, 50, 70 million dollars, you can't just put all your eggs in a basket. This program has to be like any other considered program that you develop in a company. So you have to put a budget behind it and you have to layer things on. So if you put all your eggs in one basket of just a marketing group, that's what you're going to get out of it. But the most successful campaigns, I'm sure Rebecca and Mike, will attest to this, is it's a multifaceted approach. You want to layer things on. That proverbial 1 and 1 makes 3. If I'm going to have an article in Forbes, I need that to be picked up somewhere else. So it is a program, there is an investment, there is a chronology behind it, but layer things on and bring as many opportunities to the table that you can, use over time. You don't want to do it all at the beginning because you can't handle it. You have to pace it over time, and you do have time. That's the great thing.
Perfect. And we got a question from the audience, and then I want to jump into something with Rebecca. But Dave, Rebecca, if you both feel free to share your comments on this. But where did you find these, different partners? Whether it's digital marketing, newsletter. You mentioned Bazinga with Gage Cannabis. How did you get those introductions? And how did you find them?
Well, okay. So for us, it's just relationships. Being in the business for a while, as I said, what's transpired in the communities that at least I'm around is that a lot of the folks that traditionally did marketing, after the fact as a public company, have now expanded their horizons and are looking at pre-public deals because of the advent of Reg A's and offering memorandums and the like. So a lot of groups are actually eagerly trying to find opportunities where they can test, their algorithms and their technology against it. But then I would also say there's the usual suspects out there. There's some really big marketing agencies or newsletter services out there that aren't paid. They're paid services. If you want to get their reports, you have to pay them. But their whole goal is to build their database of paid subscribers. And they use opportunities like a Shackelford, perhaps, to engage their community, to give them opportunities to invest in deals that they would never ever see as a quote unquote armchair investor. So there are groups out there, and very large groups throughout Canada, throughout the United States and Europe, that do this. So I would say anything from newsletter writers to online marketing groups, traditional retail marketing groups, that go out there and do online campaigns. I know DealMaker is surrounded by a lot of groups that they are familiar with, because a lot of these groups are trying to help the investor communities and issuers like us find that targeted database. So yeah, just through networks and communicating and networking.
Yeah.
I want to jump in and really highlight something Dave said earlier, because I think it's really important. The muscles that you build as a company building out this program is really useful and important. And I like how he said, we used to do it post go public, and now we're doing it earlier, because figuring out your messaging, what channels resonate, how you're going to sell your product. For a lot of companies, this is something really important to do anyway, to build that internal muscle. So whether you're doing it for capital raising and then extending it to your product or vice versa, there's a lot of overlap there.
Yeah, absolutely. And then, one of the things we've touched upon, and I think is, Dave mentioned really well, which is the importance of, not putting all your eggs in one basket, multiple layers. And then the byproduct of that is, Dave, you mentioned a couple thousand, like 2,000, 2,500 investors that came in on one of your raises. We've seen it go much higher than that. And when you're talking about hundreds, if not thousands of investors, Rebecca, can you talk about the importance of analytics in that process?
Yeah, definitely. And that's something we're constantly developing. And we're so excited to be working with clients like Dave, who are getting so sophisticated at this, because we just keep upping the ante on the tools that we can give them. Because if you think about it, when you're bringing in now thousands of investors top of funnel, that funnel conversion element becomes really important and a really cost-effective way to convert more capital from just leads in to actual investors. And so the kind of tools that we're constantly doing in terms of being able to segment, okay, how did my Morning Brew publication do compared to my Hustle publication, compared to the traditional news release that I did, compared to this newsletter, how are all those investors converting, giving your IR team the tools to do a quick follow-up, and being able to be really agile about how your message is being received and then adapt it is really going to save you tens of thousands of marketing dollars as your team. The more transparency and data your team has, the better they can communicate the message and close investors with the right message.
I was just going to, Mike, if I can follow up to that, because I think that's bang on. And one of our large, I'm not proud of it, but one of our failures is that, when I look back now, when you're doing programs like this and you are marketing, there's intermittent flows of people coming back to you through landing pages or whatever the case might be. And sometimes it's an avalanche, like Niagara Falls, volume of investors, and sometimes it's very, very slow. You can't possibly do these without platforms like DealMaker, because just, the administrative aspect is just impossible. So you need these types of platforms, and then data is king. So one of our failures, though, is, and you realize this going through the process, and I'll share it with everybody because I think it's really important, is that like anything, very few people wake up every day and say, gee, I wonder what's new and what can I invest in? But there are people that, for one reason or other, come by. And like anything, if you can't get that person over the line and close that investment in a short period of time, they get distracted and move on to the next thing. And it doesn't matter if you're working with a marketing group or not, because something is always being marketed the next day. So, one of our failures is that if I look back now, and there's a lot of reasons for it, but there's literally over $1 million in our system that wasn't closed. And it was because there's a number of reasons for that. But one of them is simply a failure to expeditiously, follow up and get those people over the hump or solve the problem that was there. And sometimes it's volume related. So, when you look at these types of endeavors, you just have to be very, really, I guess, be pragmatic in the approach. There's a lot of work that has to happen in the background. That the platform is only as good as you make it, but you also have to use that data, engage with that data, and roll it over. And there's some really good companies that have done some really interesting things in doing nothing but, closing. I know it's an old, thing, but you have to, because if you're spending money on getting your name out there and your brand out there and bringing in investors, It's an awful shame that you can't convert those investors. So, and that was our failing. And I would say for anybody else doing this, just make sure you're giving it the time and attention it needs, and putting the people on it. It is a legitimate part of your business. You know, a lot of people just think, oh, something happens in the corner. No, it's up to you guys. You know, it's up to you guys to make sure that you have a program in place that ensures that every dollar that's, you know, wanting to come in can come in.
Awesome. Yeah. And I mean, and sort of how did you manage that through marketing automation, the follow up? Did you rely on sort of investor relations?
So, and I've had this conversation with you guys. So what I would say is, I think the next step in this is, before we set it up, we set up a really bespoke kind of CRM system. And the gap is right now, and I mean, admittedly, I think we can all work on this, is that what we would traditionally use on our side of the business to manage this has to now connect with a DealMaker, whatever platform it is that you're using. And our disconnect now is we ended up juggling our CRM with DealMaker, which is kind of a pseudo CRM, and trying to have those communicate together. And as time goes on, I was on this conversation the other day, you know, companies will develop the APIs to allow these to communicate so it could be more efficient. Because there's a lot of things that DealMaker does as far as outreach and automated servicing of the investor once they're in there, that we're aware of, but we can leverage greater than what we're doing right now. So we want to remove the redundancies and make it as efficient as possible, because the communication has to be consistent for the investors, you know. And I mean, you guys all know, and I won't spend much time on it today, but there are things that will grow into this, Rebecca said, you know, not just data, but the ability to integrate other platforms that allow folks like us to be very, very efficient, and I guess, connect that data in a way that makes it usable for all of us.
Awesome. And then I'm going to ask a question, and I'll say let's try to answer this as succinctly as possible, because I've got a big meaty topic that I need to pass over to Andy around some of the marketing rules and stuff for the OM in Canada. But one of the things that we come back to a lot is, and we've titled the presentation, you know, direct to investor, and, you know, how to turn customers into shareholders. But there's another side of it, which is turn shareholders and investors into customers. And, you know, Dave, did you experience, maybe if you could share your quick experiences with, you know, the duality of marketing to customers for investment versus, and as well as, you know, turning investors into customers. And then Rebecca, just sort of touch on that from some of the experiences that we've had at DealMaker overall.
Yeah, I would say it's 100% slam dunk if you do it right, that those investors are customers. And as you guys know, the most successful campaigns have been retail campaigns where they were customers first and then became investors. So, you know, when we launched ours, everybody thought we would have this very good over-the-counter brand for Shackelford. And a lot of people were drawn to that, saying, you know, I would trust what a doctor does, especially with that experience. So we kept that database and nurtured that database for precisely that reason. You know, whether or not there'll be pharmaceutical customers down the road, I don't know. But if we were a strictly customer facing thing, slam dunk. You know, it's a beautiful, beautiful platform to do this.
Yeah, I think BrewDog is the original consumer-facing brand story, right? Beer company, you know, they give the extras where you get the beers on your birthday, and then you create a loyal base of followings. We've seen a lot of companies do different offerings like that. We can get into another discussion about what those extras should be on a Reg A or a Reg CF campaign to really incentivize people. If you're a public company, you're going to want to think about how to incentivize people to come into this offering when they could just buy the shares publicly. But we've seen issuers have a lot of success with that. Prosthetic limbs company getting, you know, people signing up to be the first users of those things. So there's a lot of flexibility in the way you can approach it, depending on what your product is.
Yeah, and just to put a final cap on that, like that was one of the learnings that we've had for like a very, very focused medical technology company. You know, it's not a retail focused business, but they had surgeons, you know, from all over the world calling them up because of the marketing for the raise that has propelled their revenue forward. And you know, it's very outside of what you would consider the traditional B2C kind of conversion cycle to look like. So it's having an effect across the board. Now let's get into a meaty topic, but a really important topic. So Andy, this is over to you. There's a lot of complexity. You know, the SEC has been very prescriptive in terms of what is allowed and not allowed for A and CF deals, but that's not the case in Canada. So complexity around retail raising, misrepresentation, forward-looking information. Can you explain to our audience some of the pitfalls surrounding this? And I will also share a slide so that everybody can actually take a look. 1 second.
Yeah, so from a legal perspective, the marketing analysis can be broken down into two main elements. The first is the content of the marketing itself, and the second is the conduct which the company engages in during the raise. Starting with the first point, your content cannot have any misrepresentations. A misrepresentation is either a statement that is not true or an omission of something that you should have said to investors. Some examples of this made in the context of an offering memorandum include failing to disclose that the proceeds will be used to pay off prior investors under a debenture, for example, or in the case of a real estate company, failing to disclose which property the company will invest in. So it's important to remember that anything you put in front of investors, whether it's an email or an Instagram post, can be ultimately used against you. And some classic mistakes that companies make is promising future information that never ends up happening. Once the investor has that on a piece of paper, they can go back and show that to the regulators, and it's something that can be quite easily demonstrated. In terms of conduct, other than the fact that you can't solicit investment without relying on a prospectus exemption, there are, generally speaking, no prohibitions on the type or style of marketing activities that you're allowed to do. And that's what makes the Canadian rules so much more tricky than the US, because in the US, the regulators clearly tell you, listen, this is the type of marketing that you're allowed to do. These are the types of activities that you will not get into trouble for. In Canada, it's open-ended. So really you can get into trouble for a lot of things, which is why when you're looking at the analysis of how you're doing your raise, it's really a spectrum of behaviors that you're looking at. The more of them that you engage in, the more likely you are to be offside the rules. And the rule being that if you're somebody that raises money from investors, you're required to be registered under the Securities Act as a broker or a dealer. So if you're doing the raise yourself, you want to make sure that you minimize these types of behaviors that can lead you to have that registration. And some of these include, spending most of your time raising money rather than running your business. If you're doing that's a classic red flag. Using aggressive sales tactics. If you're pressuring people to make investments, discussing the future value of the investment. So saying you'll have 100% return, money guaranteed in 1 year, or we're going to go public in a year or two, you'll get your money back. Or doing raises consistently. If you're spending 3-4 years constantly raising money from retail investors, then you're probably going to be offside. And you have to just keep in mind that anybody that you're soliciting to raise money from can ring up the regulators and basically tip them off. So you'd work with your lawyer to basically structure your raise in a way that you follow best practices and avoid this conduct essentially that will basically tip you over the edge into requiring a registration. And that, I would say, succinctly summarizes the main considerations to look out for.
And I just want to jump in and highlight, I love Andy's put so much thought into this, and it's really important for us that everything is done in an appropriate way. We want investors to be protected, and I love that Ozeal, they really take a business approach to this, which is important. They've thought about what you should do and what you can't do and how to stay on side and do things in a proper way. So whatever legal counsel you're using, you want to make sure that they understand retail capital raising, because we do so many raises. We see the difference when you have advisors that know about retail capital raising or they don't.
Yeah, and we've got a couple of questions just from the audience that I want to get to. So I guess back to you, Andy. Who at the company can be authorized to do the raise?
Who in the company? I mean,
Yeah.
generally speaking, it'll be the chief financial officer, chief executive officer that does the raise, but anybody can be authorized to do it. What I would say to avoid is hiring a team, like an entire team of people in-house just solely for the purpose of raising money. If you do that, then that's been clearly outlined by regulators that you'll need a broker. People who aren't registered can't do that kind of behavior.
Right. And is that, and I guess the other side of it is, can you pay finder fees for the raise?
Yes. So using the offering memorandum, you can actually pay finder fees, unlike crowdfunding. So that's another great way to tap into, you know, their own network and other people's network to increase the limit on the raise. Now, if the finder fee is going to the chief executive officer or chief financial officer, then that's an issue. So the finder should ideally be somebody that's arm's length to the company.
Okay. And any issues with not using an EMD or broker dealer for the raise? And when would that, you mentioned, you know, if you're hiring out a team internally, that would cross a line, but any other areas where you feel that might be mandatory or necessary?
Yeah, so again, there's the issue and the complexity with this area is that there's no one single thing necessarily that will lead you to have to hire an EMD or a broker. And in fact, the OM exemption itself was designed for companies to be able to raise money from the public, and there's no rule that says you have to hire an EMD. So you can do the raise yourself, but an EMD is more so like insurance. Look at it as a way to, it's extra cost, but you know that you can avoid being on the hook for otherwise having to be registered under the Act. On the other hand, yeah, that is going to significantly add additional cost to your raise. So if you're doing it just once or twice, and provided you get legal advice, it should be fine to do it yourself.
Perfect. Yeah. Okay. And so I realize we're now 12 minutes left. We've got a couple more questions to open it up to. I think that, you know, there's probably one thing that I wanted to, you know, get Rebecca's opinion on, and Dave as well. You know, we've talked about the Robin Hoodifying of the capital markets, the rise of the retail investor. We've seen it so much over the course of the last year, and the power and the hunger and the engagement with retail investors in these types of deals. You know, where do you see this going, Rebecca? For you, you know, where do you see this going, and what is your vision of this overall? And then I'll open this up to Dave and Andy as well.
Yeah, I mean, I think it's just going to get more and more powerful. It's really got the backing of the SEC in the US, which is huge. If you look at the stats on, you know, Gen Z, 2/3 of them are not working with investment advisors. They're using self-directed investment accounts. So it's a bit of a generational thing. People just getting more and more comfortable making their own investment decisions and being comfortable with that. As well, you've got technologies like DealMaker that are empowering this sector in a new way that hasn't been possible before. So the complexities of the OM exemption we discussed at our last seminar, right? Like it actually was virtually impossible to do across Canada OM raise without a software like DealMaker, because you've got different provinces and different forms that you're trying to put people in. And it's just like the paperwork of 70 pages to get someone into this document, forget it. Like it's not going to happen. But when you have the question flow, you can read their address, you can segment them properly. All of these things are combining in this apex. And then we've got, all these alternative trading systems happening where, again, people are self-directing trading in the US. And I think we're going to see more of that over the next couple of years. So we're at an influx where fintech is really impacting the capital markets in a way that it hasn't. It's a sector that hasn't changed since the 60s or 70s. A lot of the infrastructure is old, and a lot of new things are coming out to completely disrupt the way things are being done.
No, I would just echo that. It's a very, very powerful demographic. And it's not just, the millennial group or whatever, but everybody says, our investor base was from 18 up to, 90. So, and I think that's fairly typical. You have a lot of folks that are feeling empowered to make investment decisions on their own and have the resources to do it. Some people are doing it $1,000 at a time. Other people are doing much more. So it's just, again, it's a different level of handholding and a different level of work to, get to those individuals and then work with them moving through. So it is a hands-on business now. I mean, when you have 2,000 plus investors, it's very, very hands-on. So it's a great demographic. I think it's a wonderful thing for democratizing investment, especially for earlier stage companies. But as Andy and Rebecca and everybody are saying here is, just got to be cognizant of all the various different regulations, both in the US and Canada, to make sure you stay on side and do what you say you're going to do, and do it properly.
Awesome. How do you think about, you mentioned sort of, Dave, at the very beginning, when you were thinking of your go-to-market plan and how to sort of value yourself, how to price the deal. How did you approach that, and maybe open it up to Rebecca and Andy about how to sort of think about valuing the deal and structuring the offering overall?
Sure. Like any company, you're going to look at your comps and see where you fit into that. Next thing you do is say, well, in our case, it's quite particular because we're more so a traditional pharmaceutical company. So Canada isn't a traditional pharmaceutical venture country, so we're going to get a valuation here based on whatever the Canadian market dynamics are. And then we look at the US, which is very much a jurisdiction that supports pharma and medtech and that whole sector. So going out of the gate, we knew we would get a probably better valuation in the US for the state we were at compared to what we did in Canada. So that was one factor for sure. Doesn't mean we were right, but we had to go out there and test that thesis. So we did, and we found our sweet spot. Here, I think we're going to raise money, and I'm not kidding you, at a seed round of around $10 or $12 million for a database of 27 indications, which is unheard of. But it's just what the market was at the time. So down there, we ended up raising money at around a 40 million US valuation. So still below market, but realistic, I think, given the status of growth we were at the time. So I think you just have to be cognizant, like any business, know the comparables, know what your value equation is. And just like you would negotiate with a broker dealer or whomever, see where you can get the best deal.
And just to add to that, it's easier with the OM to find comparables because the OM is a public document. So you can even look up to see, what some of your competitors have done and how they've structured their raise.
Yeah. And you mentioned something that really interesting there, Dave, just with the, Canadian landscape and, Canadian institutional raising is always a very conservative thing. Rebecca, maybe jump in and touch upon, how that differs from a Canadian retail perspective versus the Canadian, the conservative Canadian institutional perspective. What we've seen from Canadian investor behavior coming in on US deals at US valuation.
Yeah, I think the way Dave described it is exactly right. Like when I went to capital raise for DealMaker, that's the exact same process that I followed. So of course, if you're creating a go public company and you have investment bankers involved, they're going to help you with the valuations or somewhat direct the valuations because they're taking it out to their industry. or their network of contacts, really. So they're going to be driving what those contacts need to see. But at the end of the day, I think it always comes back to a founder understanding their comps, understanding what the value they provide, what the trajectory they're on. And one of the things Dave touched on, I think we've really noticed is the US valuations are much higher than Canadian company valuations in general. Like the Canadian investor market in general, I've always found wants to see you hit break even, much more conservative valuation. The US market, go big or go home.
Yeah,
I think there's a psychology behind that. You know, in the US, a quote unquote penny stock is anything under $5, you know, small cap. So here, a penny stock is a penny stock. So I think you have to appreciate that. I think there's a lot of US based investors that still see value in early stage companies and see a bigger value than we traditionally would. It doesn't work across the board, you know, to be sure. But again, just do a little bit of work before you go out there to see if there's, you know, a market for that. And I think what Andy said is bang on. You know, whether you're doing an offering memorandum or a Reg A, go to Edgar and CEDAR and stuff, and you can see, you know, analog after analog of companies and how they're valuing at whatever state. So you can get a pretty good sense of what the market will bear.
yeah, absolutely. Andy, just a question I want to cover off, and you know, because it's so much less clear in Canada than the US. Anywhere where you would recommend sort of being able to read up on some of these things in more detail?
That's a great question. The answer is I wish that there was. You can go to the companion policies of the national instruments if you care for some lovely nighttime reading and try to discern for yourself. But really, the only way to kind of cobble together where the regulators stand on this is to look at the decisions and what factors went into the outcome. And unless you're a lawyer and you have nothing else to do, I don't know who would be
Call
interested
Andy.
in doing that.
Like, just the answer is just call Andy.
Yeah, I think that's pretty much it. Call Andy, because there's not a whole lot. And I think, you know, the final point, first off, thank you everybody for joining. I think it's been a great discussion. I've really enjoyed it. Thank you, Dave. Thank you, Andy. Thank you, Rebecca. It's been a great chat. I guess anybody, if you want to give your final sort of, you know, 30-second soundbite on, you know, any advice that you would give to the panelists as they sort of think about embarking upon one of these raises. And yeah.
I guess I would say that you know, you're going to have your first mover advantages and first mover disadvantages. So, you know, this is really an exciting opportunity for Canadian investors to be more involved in your business and Canadian companies. But you got to accept the benefits and the pitfalls.
I'm going to say I 100% agree with Andy. It's a great opportunity. It's not fully fleshed out. So everybody's learning. Quick little anecdote. I've called the SEC multiple times, asked questions specific around Reg A's, and they would pause and go, I don't know the answer. So and that's people on the file for Reg A's. So it's an evolving process, both in the United States and Canada. Have good representation, you know, like work with folks like Andy that know what they're doing. So you're doing best practices regardless. And you know, things will generally work out okay. And the other thing I would just say, because I noticed some people had notes that they were sending over for questions. I apologize because I haven't texted back or answered your question. Just send Mike or somebody a note and he'll hook you up, and I'm happy to answer those questions. And thanks everybody. Thank you guys.
Yeah, that's great. I totally agree. I would highlight what was just touched on. Working with the people in this space who have done it is a huge value add, because you don't have to figure so much out on your own. And things are developing rapidly. I see one question there about an API. Yeah, we're working on that, increasing the amount of information sharing between systems, increasing access to data analytics. All of this stuff is moving so quickly, which we love, which is why we love being in tech. And we're excited to share what we're learning with everyone.
Awesome. Well, thank you, everybody. Thank you to the panelists. Thank you to all the attendees. We will send along a replay link and the slides from the presentation today. If you have any questions, feel free to reach out to Rebecca or myself at DealMaker, Andy from Ozeal, or even Dave. And we'd love to chat about this. We love nothing more than chatting about these things.
Thanks, Mike. Thanks, everyone.
Thank
Thanks,
you.
Mike. Thanks, everybody.